Good evening, traders. My name is Dan Hussey from Zaner Ag Hedge, bringing you our strategy of the week update here for May 5th, 2022. Doing it a little bit later at a different time, but I think this is a good time to be doing it, particularly tonight and for this time of year or this point in the cycle for row crops. We will be highlighting some of the energy markets, going to maybe get to some of the meats as well. But main focus tonight will be on the row crops because we are really, well, and it almost always is, but we are at that point where if we're going to be following the patterns from last year, we might be getting closer to a top than we would like at this time, I guess. But we also haven't seen that blow off and that explosive price action into and through May and into June that we had last year. A lot of that is probably due to the fact that we've had improving weather conditions here in the U.S. Next week is looking like the week to get combines or to get planters running, I should say, and to get the crop in the ground. Slightly behind on the curve on the plant, but that can all catch up here quickly. The big issue that I'm still hearing, and I would love comments on this, is I'm hearing about a lot of issues with equipment. And it's not that you couldn't or you wouldn't if you wanted to, but there just isn't that part around, or your local dealership is so backed up that they can't get things and the mechanics can't get things done because of that supply chain crunch. I'm hearing that from a number of people. I hope they've gotten those parts they were needed. The guys I knew we were hoping they'd come in here within the last couple of days, what have you, so that we'd be ready for next week. Anyway, all that being said, that is probably the biggest contributing factor to what's weighing on the markets right now. The fact that over the next week or two, with decent weather, there's probably going to be a crop getting into the ground. And so naturally, the market may want to take a little risk premium out. Now, that doesn't mean we are out of the woodwork for the rest of the year, right? Planted acres are still at risk from weather and other effects, in a time of the year and a time in the cycle where we're still inverted. We still see strong demand out of Asia. And without much of a crop elsewhere in the world to compete with ours at this point, there isn't much bread to be spared in a literal sense. All right, so row crops here this evening, a little softer. Let's hop in and begin with our corn market. The July corn, we've been in our last strategy of the week and over the last couple of weeks, we were talking about this May 10th line I drew. It's not a law or by any means something that I'm necessarily going to advocate we need to be short once we cross that line, because by this point last year, right, we had started selling off because we're still very much flagging, at highs. The last 2 weeks of trade for the corn have just been a 20-cent range, maybe 30-cent range here between 790, 820. Really not spending much time above 810. Equally not spending much time below 790, and somehow finding our way back to $8. Very reminiscent of some of the other old flags we've seen in corn. Some of them lasted a lot longer, like our last year, that May through August kind of time frame. Again, this is of course that run up into the May high that I was talking about, and the pullback and then sideways price action we had through our harvest low, to which then we began the next cycle higher through this marketing year. Now that we're potentially finding a similar top, and okay, well, maybe that's going to mean a pullback. So how far down the rabbit hole will that go? Well, we're going to hop forward to December here, because I think it's a lot more appropriate to be locking in, or if we're thinking about protection to this point, looking out towards December. Mainly because, hey, 730 December corn right now. Come on. We can't really get better than that on May 5th. Can't do much better than that on May 5th for a new crop sale. But with all that being said, I do think there's still the ability for this market to head higher. And we'll cover some of that here shortly. So 18-day moving average on July corn settling below it here today. It was at 797. The last 2 days we were basically flirting with that level. The 18-day moving average, I use it as kind of an intraday or short-term trend indicator. Market seems to respect it pretty diligently. There's oftentimes, many times that we will come back and test the level before, heading higher. Usually if there's a break below, it's only for a moment. here, back in March. It was for a day or two, but a sustained move below could, to me, result or be signaling for maybe a larger correction. 55-day moving average down around 741, 100-day down at 682, 200-day down at 621. Lots of levels of support. Almost every 50 cents as we go down, you could justify some kind of level, whether it's our fibs or these moving averages, whether it's congestion zones like this 708 to 675, the breakthrough, the $7 handle. We could come back down to test that level, between now and midsummer and even into next year, even into next fall and our harvest. We are, however, oversold on the daily stochastics. That is true in both the December and the July contracts, but that does not mean that the market has to necessarily bounce. It just, of course, is an indication that, in a warning signal here that momentum has waned and maybe bears are taking over. And that market, right, when you do find a top or something to this effect, oversold conditions like this can stay oversold longer than we can stay liquid. So, a quick flash crash or a quick couple days sell off down to 760 or 741 and a quick snap back, it would only keep this, oversold for a short period. And we could still be heading, significantly lower, right? 30 cents lower, even in oversold conditions. I'm just painting a picture of how just because it's oversold doesn't make it a buy. Just like how it was overbought here didn't make it a sell. But it certainly was a warning that, okay, we might be getting to the point where consolidation needs to occur to bring that RSI and that stochastic down. And so that's kind of what's happening. Trendline support here. July corn for me comes in around 760. That area does interest me. In fact, it's our old highs here, and then kind of the breakout from early April. It would also set up a slot, a head and shoulders pattern would set up into it, right? We might get a neckline here around 780. You could argue there might have been a right shoulder there forming at 812 on that rally here 2 days ago or 3 days ago. Yeah, but and then a break below the 18-day moving average here, below 789, and certainly below 780 would constitute that neckline break. And justifiably, you'd be reversing this last leg up into that type of setup. So if that's the case, again, pull back down to 740, 750. Can't totally rule it out for the longer term uptrend. And that kind of pullback might be healthy for this time of year, right? We weed out some of the weaker longs. The market resets in the sense that it goes down to find fresh buyers and to find out where support really is. If we have price rationing of demand, up into this area of $8 in corn, and buyers aren't totally committed to buying corn and taking delivery at $8 because, hey, that's expensive for any kind of input that we're talking about here, with the exception of maybe ethanol crush right now. Cattle and pig production is not loving this $8 corn right now, and I think we're seeing a hesitancy on feeders right now. We'll take a look at the feeder chart to kind of confirm this idea in a minute. But feeders are coming under a little pressure. We can't break through trend lines there, and if feeders aren't rallying, and we're not getting feeders on feed, you're not getting right. You're not going to get. You're not going to, sustain a rally in corn. And a great way to bolster, feeder procurement, right, would be a drop in corn prices right now. It would widen the cattle on feed margins, and people would take the risk with the herd. All right. All that being said, oil prices right now, pretty good rally here today. Gasoline prices rallying. Almost back up to highs effectively, but crude oil, I should take the monthly chart off here. We don't really need to look at that just per se. The June crude has broken through that trend line. Kind of no matter which way you draw it here against the highs, we're making constructive price action off the lows. You're holding trend line supports. You're breaking through trendline resistances. You're making higher highs, higher lows. That's not only true of the daily candle, but now the monthly candle. As you see, May breaking above 110 there yesterday, going to 111. That was a new higher high. Of course, crude's probably going to pull back now to burn anybody who bought the 110 breakout. But my opinion is going to find support here, sometime down, probably before the $100, 128 lows of the month, probably before that level. But we'll see. I'm not the end all be all right on the crude market, but if this market wants to continue higher, it can. Right? We have an uptrend starting. We're breaking through, making higher highs, higher lows, going through old highs. Some levels to look out for: 116 above, 130 above that. I don't want to say we're into uncharted territory because we've been up here in crude, but we've only been up here, for moments in history, well, much higher, right, up to 130 and above is what I'm referring to. But this consolidation and sideways price action we've had has been very supportive. It's coming in at a 50% retracement from the last swing, from 62 lows to highs. So moral of the story here is on energies, we're still pretty bullish. The ethanol crush is still looking pretty good. It's absorbing all of that ethanol into stockpiles. We're even drawing on those stockpiles a little bit. It looks like the sixth straight draw here. We're down over 10% off the highs in those ethanol stocks now. That's a good look for corn this time of year. Now, granted, we still are going to have a wall of corn coming down, upon us in the fall, and good growing season, of course. Hope for one, but the La Nina effects that are forecasted for this year are still prevalent, and something we also need to be aware of. That the weather effects of this year may not be done. And the perfect storm could be brewing for row crops. However, in the near term, with the risk off and the volatility we're seeing in other asset classes, like the S&P 500, for example, that could easily, here you go, let's bring up our daily chart here for the SPO. Lower lows and lower highs now in the monthly candle to start the month of May. We break today through the 3-month lows at the 4,100 level. Now, granted, we rallied all the way up to 4,300 in a remarkable 250-point short covering rally in just a day's time before reversing all of that yesterday. Today doesn't look good either. Could this be 3 waves down? 1, 2, 3 down in, or maybe this is A and then an expanding A, B, C. That's how I would actually that's how I would definitely classify this an Elliott wave. And that would mean that an equal X here, a measurement of A, which is just from the 48.08 down to 42.12 there, equal X isn't that much further below that low that we had, 40.35.50. Kind of a good extension there. The only issue I have with where support is right now, or where we found support on the S&P, is when we draw that big old 50% from 21.62 all the way up to 48.08. It does feel like below this threshold of 4,100, man, there is not much in the way to hang our hat on, is there, until we get all the way down to this 3,500 figure. And that comes from both the 50% level, that comes from our old breakout. You can see the little consolidation here for 2 months' time and last October, or 2 Octobers ago, to October of 2020. And then, of course, the big sell-off and the old highs at 3,400 we had before the pandemic crash, or what I like to refer to, effectively the lows that we formed here. And this sell-off I referred to as Black Millennials, Black Monday, whatever Monday it was. I think it was right here. Yeah, it was this. I gotta find the day. Anyway, one of the Mondays in here, I personally deemed the Millennial Generation Black Monday. If you look back on charts, which I'm going to right now, because if I don't take the time to explain this, I'll just sound like an idiot. But here you go, monthly chart of the E-mini S&P. Last 20 years of it. Yeah, that doesn't do me justice because I need the S&P 500 And we need to look at something that is a little further back than just the monthly max. I want everything. Yeah, there we go. Going back to the $4.40 low after the great stock market crash in 1929. Okay, so going back to the 80s in the S&P, and the last time that we had an inflationary market that drove, well, I shouldn't say that because obviously the 90s and the 2000s era was an inflationary type market that expanded markets. But that was all a result and kind of I think how do you put this, a momentum push after the technicals that we're going to walk through here for just a minute. We'll get back to row crops in a second, but I do think this is kind of important because the volatility we're seeing here today, I do think it'll be short-lived. And any kind of pullback we see in the stock market, it could be a opportunity to look for positioning for a longer time frame. All right, so back then, coming out of the 70s, we had actually very similar type of recession. It was a housing collapse, the savings and loans collapses. We go off the gold standard. All of these things happen. Basically, you're coming out of the 60s. It's a turbulent time, and that's reflected in both the markets and social, reform. Very similar to kind of what we're seeing over the last 20 years. Then started a rally that more or less took the market from a 50% retracement, which, by the way, that 1970 lows and 60, and from the all-time highs of $121 down to the 60 lows, that's a 50% retracement. So the market pulls back 50% and then starts to proceed over the next 5 years rally in 1980, making highs into $140. Fast forward a couple years, I mean, this is effectively back towards like 2012, right? If 2008 recession is here, ding. Now we're up into the 2012 period, right? Pull 5 years after 2008, bam. The S&P or the stock market is breaking out to new highs. And that's very true if we go fast forward here to 2008, our low, basically from a 1500 top down to a 670 low is pretty much a 50% retracement, a little deeper, but what's a few hundred points among a couple decade correction in the S&P. We then break out, right? Fast forward 5 years later, we're up to 2000. We're breaking out of the old highs, the old-time highs, right? And the market has set up for an impressive rally perhaps, and it just kind of keeps going up and until eventually makes a top around 3,400. We know what came after that, right? We had the pandemic pullback, or Millennials Black Monday here. We go back to that post 1980 breakout in the S&P, the run up to new highs to about 340. Interesting how it was 3,400 in 2020, 340 back in 1985. Nevertheless, I guess it was 86 or 87, whatever. What year was it? 87. Okay. I was a 1-year-old, so actually I would have been, yeah, it was pretty much on my 1-year birthday. Anyway, Millennial Black Monday, obviously very reflective in my opinion. Pull back from 340 at the all-time highs there down to 220 or 216 to be exact, the Black Monday lows, whatever. Market then proceeds to rally. By the way, that's a 50% retracement back then from the recession lows of $60 up to the new all-time high. There it is at 340. The market pulled back into that 50% retracement at 229. Let's fast forward 30 years to the markets that we're trading. All-time highs happen into 3,400. We get our pandemic pullback. Millennials Black Monday pulls almost into the 50%. Not quite there, but hey, that's enough of a dip, in my opinion. 1,000 points off the high and right down to 2020. Kind of reminiscent of that 220 low we saw back in 1987, before the market then rallies to a new all-time high. Yeah, I'm not kidding here. From October of 1987 until, well, it didn't even peak until 2001, but the 2000 dot-com highs. We then enter into a 13-year bull market. And I got no reason to believe the same thing isn't about to occur. With all that being said, let's fast forward to where we're at today, and you'll see that we're not that far off from already achieving this. We're pretty much here. We got from that low to the 400 level, basically a 200-point rally then would be a 2,000-point rally today in a fraction of the time. We went from 2,200 to 4,800 in about half the time, in fact. It only took 2 years to get there. Last time we did this type of rally, it took 5. 88, all the way up to 92. Oh, I'm sorry, 6, 94. Nevertheless, the bull market continued. I mean, it was obviously not everything is the exact same, but boy, history repeats itself, and it seems like the stock market is no different. This correction we're seeing right now, I think is very similar to this 480 pullback, which the lows then were around 4,300. I don't know how much lower the S&P will go if it's following the same kind of analog. Now, granted, obviously here we have a different time frame and a different time schedule. We moved the last 2 years farther faster than we ever had historically. But those are markets, and it's really crazy to watch the S&P doing the exact same thing it did 30 years ago, just moving the decimal place over. Like literally just multiply the raw price by 10 and it's almost identical in both time, price, what have you. And so that adding on a 10 multiple, that's inflation. The dollar just lost 90% of its purchasing power effectively, right? What cost you $1 now costs you 10 is the theory. There, it doesn't, of course, work and track into commodities directly because, to quote Jay Powell, the transitory nature of inflation, it's not really transitory. It's just never static. So it's always in flux. But inflation never really goes away so long as you're dealing with fiat. And at the end of the day, it's a race to the bottom for all fiat currencies. And the one that stinks the least ends up being kind of a reserve. And that's what we see with the U.S. dollar over the last 40 years. But our capital markets, like the stock market, they have the tightest correlation, right, to that capital flow relative to other goods and services. Money flows in and out of the stock market like water. Hedge funds get liquidated for hundreds of millions of dollars every day or put hundreds of millions of dollars at risk. Billions, trillions of dollars are flying around in the equity markets and the capital markets. Yes, that's happening in commodities and other things too that drive inflation, but commodities and other services and goods that would fall into the basket that is losing its purchasing power or gaining value, or the dollar's losing its purchasing power against, which is what inflation is, that basket of goods is always in flux. And I'm not talking about how the Fed decides which one to count. I'm talking of course about just look at the price of oil and how volatile commodity prices can be. There's a scarcity to demand as well, and prices where we decide not to buy things and wait for them to come down. All that being said, pretty interesting hour in the S&P, and there's a big reason I'm not too worried about the bear market we're seeing. I think we're closer to a bottom than we're not, and that was a big reason why I felt the need to point out that equal legs and everything we saw here today. Now, the pullback we've seen, pullback to 3,500, the full 50%, I would welcome that. I think it's a little bit deeper than it needs to go, but in this rate rising environment, we'll see what happens. The only difference, the major difference that we had between 1985 or these two markets is what interest rates were doing and the environment that we were in. interest rates, from 85 through, basically 2012, my whole life had been, on a decline in the United States. Um, that's changed. They got no lower to go. So now they're only really coming up. And that's a big reason why a lot of analysts like myself think that this rate rising environment isn't actually a really bearish thing for the stock equity indices. In fact, we just had a 50 basis point hike, and we're still not in bear market territory. When you take a step back on this monthly chart, the S&P, for all intents and purposes, is kind of in a bull flag. I mean, today's price action aside, breaking a little lower, which, by the way, like we discussed here, could be a signal for a 3-day, break here, and now 3-month break, excuse me, of those lows, and a reason we're looking at 3,500 and other levels lower. But a major reason I'm pulling up the equity indices and looking at them at all is because of that risk on risk off metric. If we see some decline here, it's probably going to weigh on our other markets, and there'll be nothing we can do about it. All right, let's get back into our row crops. We'll come back to corn here. It was a total. I was not really planning on going on that tangent, but glad we did. I love looking at that chart. It's one of my favorite charts to go look at because it's just so pretty. I just love how much sense it all makes. Not that I've made any money on all those ideas, trading them trading them that way, right? But because who can hang on to swings like it, right, in the futures like that? But using that idea of having confidence in like my 401k or other investment portfolios where you're not leveraged and it's a investment strategy, right? That's why I look at those long-term monthly charts, because it helps us in that regard. Anyway, all right, so December corn channeling higher. There's lots of reasons that we could, be thinking we're getting closer to a bottom in the range we're in. We got, justifiably like an open gap up here. This gap lower from 751 down to 745. I'm really curious to see if we can't get back up to 750. And I feel like once we do, though, it'll be the time that we're going to $8, $9, $10 perhaps. Because the longer we leave this little gap unfilled, just the harder it is going to be on this market to get back there, take care of it, close it, all those good things. All right. All right. Kind of just want to move on to the beans, and I've been waiting for them while we've been discussing on other things to kind of either break down, because I would have a comment to say there, or not at all. And so far, we've now intraday going below yesterday's low, pulling back like we did. There was this little gap on the chart here this morning that I was aware of, and I was thinking, okay, that's pretty bullish, right? We gapped up and kind of ran on the overnight. Usually when we're really bullish, we won't see, this pullback will not get follow through. You will just head higher and it never looks back. The fact that we came back down and reversed the entire day back to that gap and have now gone underneath and kind of threatening our old lows suggests that all of that price action we saw today, it wasn't enough to take the trend over. Why? Well, the trend had to come back down and retest its kind of old supports, or the bull trends. The bulls needed to do so, or did. On the 4-hour time frame, we are coming up on our established new trend line, which is a very important level to watch. Because below this level could mean that all the progress we were making in this run-up is now over. And we've effectively wiped it away. We came back down into the 1627 area. That's the 61.8 line of the decline. The only reason I'm okay with a 61.8 line break, and I'm normally not, I normally like to see the 50% hold without giving up the 61.8. That is much more indicative of one side being in control. The other, right, they make 2 steps forward, 1 step back, and then the trend resumes higher. When you start taking more than that 1 step back against 2 steps forward, starts being an indication of, right, the shorts or the short side, the downtrend, perhaps starting to make more progress against the gains that the uptrend had just made, reversing what the work they had just done. But the big reason I am so okay at this moment, which is letting beans be, and honestly, until we're below 1600, I'm not fretting too much, is because of this range we've been in. I'm definitely fearful this range may break down and we might be making a double top into that 1640 to 1650 area. That is not something you can completely rule out, but I also see this very much as, very corrective at highs. And the market arguably being very comfortable with old crop beans being, above $16. You flash that forward into new crop. Oh, I thought I had new crop up here, but here's your meal chart. Not looking too bad in terms of a correction. I don't like that this is now the 3rd month of lower lows and lower highs, but hey, meal's just retracing. It's 318 to 494 uptrend and a full 50% retracement. I figured while we got it up here, I'd throw, I'd just take a look. Is all the way down to 407. So maybe a little lower to go. We'll see. Oils usually our leader when we start to see some real lows form. Oh, what am I doing? There we go. Novi beans breaking above its trendline resistance, right? Kind of arguably making a little more progress, but it's still against its relative highs, but it's still in a range itself. So we shall see. The big thing I like about Novi beans right now, though, is they did not puncture that 50% line and look a lot more corrective here in this pullback. And today's bounce looked like a completed 3-wave correction into a 50% retracement and old broken trend line resistance now as support. I mean, this, I could not ask for a more obvious technical reason to have been a buyer. Which I was in many accounts for our clients, but it wasn't via futures. I have preferred over this last week to position buying June calls and selling July against them. If I'm going out to October or the November timeframe, which we're going to look at some options here in just a second, because I do think there's a strategy here to be had with a 1550 or 1560 call, that we can position and make sure that, you have some reownership because, hey, sell 14, selling beans up here to lock in prices is not a bad idea at all. In fact, that goes for corn or beans right now. These are still great prices. I would be maybe, given that today was a little heavy and we are getting towards that point where we might start seeing planters really catch up. In my professional advice as a grain marketing advisor, I would, suggest it's a good time to do cash sales. Get them done. Get them on the books. If you're not upwards of 30% sold at this point, I think you're really missing out on some of the best pricing we've had for new crop come May 1st in, half a decade or a decade. Now, that doesn't mean we're without some upside or getting upside back on the table. And for November beans, I think that upside, there's some pretty obtainable strikes that we can look at right now. 200-day moving average down around 1327, 100-day down at 1410, 55 days are supportive, moving average right now down around here at 1480. And I hate being below that 18-day, but it's up around 1505. That's going to be a level I would like to see us, and you see it here holding as resistance here. That's not a great sign, but If we're getting cash sales done at these levels, the reownership strategy that I would suggest wouldn't be in futures at all, and most reownership shouldn't be. We always tend to favor trying to use minimal risk when we're talking about futures, because by limiting the risk on the future side to something that's you know acceptable in this type of environment, because this isn't a year where we're hoping and praying for the market to go higher. We have fundamental reasons and a bias as to why grain markets should trade to higher prices. And when I say bias, it's wrong. It's not a bias. It's it's what my analysis tells me, right? And what the current trend has been, and the fact that we have inverted backwardization into the type of geopolitical situations we have ongoing around the world now, it does make for a different dichotomy. All right, so 1560 calls, grossly expensive. And by the way, I don't see the reason to buy put protection here. If you can get cash or forward sales done, I think that's the better way to do it. The reason being is, it's always, I guess, it's a subjective issue, right? It depends on your personal situation, cash flows, and own risk management needs. But I prefer doing cash sales here and owning courage calls on the board still. Major reason for that is that money, two in the hand is worth, or one in the hand's worth two in the bush here. And the minimal risk we can put on the board can be adjusted and fixed and tailored for when the rally finally does come, whether it's 3 months from now, just before harvest, or if it's if we do get a little bit of a move here with weather, markets or geopolitical things being what they are. It doesn't matter, right? You have the ability to improve on price, and without a strategy to do so, you just have a sold and booked profit on your production. So there's nothing wrong with that either, even if you don't take me up on my idea to get some call reownership on or something to this effect, right? Can't go broke booking profits. And that's, of course, assuming that we're still about break-even prices in new crop for you, which I find it hard to believe you're not at a 1480 board sale for the beans. Corn, however, understandably so, but at 729 corn is probably cutting it close for a few guys. 1580 calls going for 62 cents, 1560, 67 cents here, excuse me. That's a lot of dough, but you get 168 days on it. And I think the beauty of this strat, or of the fact that it costs a lot to buy the 1560s, is that, well, you can actually bring in a lot for selling a put $3 above, darn near 20 cents here. So if that's $3 above. So if I am going to be putting on a strategy here for reownership through November, I got to tell you, owning a 1560 call and selling that 1860 call against it, it's going to be 67 cents out of the pocket to own that long call, but we're shaving, going to call it 19 cents right off of that. A 48-cent cost seems pretty steep. $2,400 per 5,000 bushels to get that upside hedge on. But a $3 upside, if we go to, $18 or $19 November beans, you've got the position on to take advantage of it. And 168 days to do so. Now, all of a sudden, that $2,400 per 5,000 bushels doesn't seem as expensive in terms of the upside you get. And keep in mind, you need to be doing that alongside a cash sale. So you take that 5,000 bushels you just sold at, let's just say you have a -1 basis at 1380 right now. You just booked that with the ability to now, on the board, improve your price 60 cents out of the money for the next 168 days. You just took 48 cents of that 1360 or whatever. Okay, well, no, it would be a 1380 sale. So now you're down to 1330 on a raw, just total. And that's assuming this 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 strategy, this reownership strategy of owning 1560 calls and selling 1860. If that doesn't work out and we head straight down from here, if you bought this, you got a minus dollar basis cash sale right now. And I mean, I'm trying to think of the worst case scenarios for a lot of people, right? Um, and I don't know, let's just shave another 20 cents off or something for a bad reason, right? Let's take it down to just the $13, sale price. Not terrible. It's still probably above a break even and above watermarks for people. And if we head higher, you've got that. That on. Now, granted, these are all things that hopefully you would have been doing maybe a little earlier too, because obviously we're at much higher prices. But and having this plan early and often will help you pick up on these courage calls. Now, okay, Dan, we just headed lower. Oh no, we're a dollar lower in the beans over the next 60 days. What do we do? Well, buying back that 1860 call is going to start to bring some more premium or money back into your pocket. Your 1560 put's going to have gone down in value. But the money, that 20 cents or so, whatever you bring in for the 1860, let's say you bought it back for $5, just throwing random numbers out here. But that's typical. You know, if we dropped $1 in the beans right now over the next 60 days, and 1860 put, that's arguably, $4 out of the money. That's in a delta of 0.14. That thing's gonna and has lost also 60 days of time value. Let's not forget that. Probably going to be worth somewhere around 5 cents. I think that's fair to say, considering if we go up $1 right now and look at what a 1960 put's going for, it's 13 cents. Let's shave another 60 days off, and And so anyway, let's just call it 5 cents it's worth. So 15, you're buying that back for 15 cents. Well, that's 15 cents we can turn around and use to potentially improve, that other call. And just looking at what the market's doing right now, improve that 1560 call. If the market right now is, pricing those at 67, well, let's just look at, what kind of call, if we spend 15 more cents, how much does it improve from right here? Now, we're pretty close to the money. It wouldn't be this realistic because you'd be a little further out from the money, but 15 cents up from, 1560 here, 10 cents gets you to the 1520. That's 40 cents off your thing, and tag another 5 cents on there. You're somewhere, it can't quite afford the $15 put, just spending the money you made on that short call. The $15 call, but see how you can, that 15 cents affords you, a 40 cent improvement on that option strike. Well, we were just talking about, a 60 cent or $1 drop in the market. Now, all of a sudden, you've got a strike that's, a little bit more obtainable. And if the market, and of course, we would try to manage this, alongside, logical reasons for, to potentially increase our risk, because that's what you're doing here when you buy back that short call and you're just exposed to the long call. You have no premium protection, and no time value protection, even though the short call does not totally cover it. It's the nature of a call spread to minimize that risk. So again, 1560. 1860 call spread alongside cash sales in the Novi beans seems like a great way to get a reownership strategy on. Now, 40 cents, again, is a lot of money. We would not be planning on kissing all the money in that call spread away. We are always logical, at least over here at Zaner Ag. I'm always logical with my hedges and even reownership. We still have levels where we say, hey, let's get out, if this thing drops, loses half of its value or more. There's certain levels of threshold where we try to minimize the risk. But all is said and done, if you hadn't put this strategy on and we walk through the exact same scenario of you're just cash sold at these levels, you did 47 cents better. You had no potential for more upside. Okay. You cash, or you don't do anything, you don't do cash sale, and you don't put the strategy on and the market falls, well, obviously, we all know, what the outcome there is. You're just losing money on your cash sale when it comes. But very quickly, we could get down to that, we we look at Novi Beans here, that 1300 threshold is not even a month away. We were down there earlier, not this month, but April and here in February. It's not that far away to get to. So that drop, that could just be the market getting into its funk, figuring itself out, trading in a larger range here. And if that is the case, if we do go down towards 1440 to 1400, we'll wish we'd done these cash sales up at these levels, right? And of course, do nothing and the market goes higher and you just have your cash on. Good for you. Glad you were right. And I hope you do some sales at higher prices, right? Because we'll always be left wishing, wanting, and needing more. All right, so let's move on to the feeder cattle. I got to wrap this up. I got a baby I need to go make sure is burp fed, and he's probably already down. His mother is fantastic. The wheat markets, okay, KC wheat because it's up here real quick. Trendline support, 50% and $11. We're bouncing. Looks like a bull market's trying to resume to me. We want to see, obviously, trendline resistance give way. It's right where we saw it today. So I'm a bull here on the wheat again. 50% from the 1087 low to high. I prefer KC wheat over Chicago wheat, and I prefer spring wheat over KC wheat at this point in terms of where my bullish stance would be. Major reasons being that well, Chicago wheat has a lot of, in my opinion, room to improve, whereas that spring wheat has had a terrible plant. Our winter wheat conditions aren't great, and it's that global winter wheat product out of the Ukraine and Russia where I think that the global demand is really being hit. All right, so 50%, 1133 could get down there. That'd be a retest of yesterday's high or 2 days ago high, and whatever, full 50. But we are wanting to see this market stay above $11 now. If it does, above 12, off to the races. I think this market's breaking out towards $13 and above. Let's see if it plays out that way. Lean hogs in the June contract. Woo. Head and shoulders pattern kind of breaking down here. 101 was a huge level that it bounced from. We basically came down, I think, in my opinion, to try to find support. This rally we're seeing might be it, but we broke through a big supportive level here, and now we're coming up to test this resistance. So if we don't get back above 110, a little worried about that lean hog. Cattle, neckline on that live cattle here, head and shoulders, left shoulder, head, right shoulder up into 140-ish. I kind of see a neckline and trend line here running against the lows here, which, we break lows of the month. We're taking out the lows of last month, and we're not far away from the lows of the month before that in February or March. And then, really, you just have a pretty solid leg lower. What looks like a very corrective, choppy leg higher, and then probably another solid leg lower. Equal legs down in a three-wave correction could take us down to 127 easily. And the full 50% retracement from 117 to 143 hasn't been touched on 130 either. So kind of got a hunch we need to go down to that 130 area in the live cattle. We will see. And that is actually and I'm looking at August feeders here, very complementary to the August feeder right now. Trend lines against the highs continue to hold resistance. The gap down today, boy, was that... I don't know. Okay, hear me out here. And this isn't me trying to say, oh, look at how good I was at this idea. Anytime we close on a trend line like this, look at this. Every time we have, right here, right here, right here. Every time we have, what has the market done? Not a trick question. Gap lower, gap lower, gap lower. Every time feeder cattle seem to hit or stop at the end of day, having traded a trend line, or go out the day close to it or something like to that effect, we seem to either gap up above it and run away, or just gap down off of it and run down from it. In this case, it's gap down off of it and run down from it. Gotta love the feeder cow. Not the most liquid market, hence why I think it tends to get pushed around by funds and stuff a little bit more aggressively. But this correction, boy, I mean, I'm calling it a correction because when we take a step back to a daily time frame, and I can't really go out to just the regular feeders, can I? No, it's feeder. Go over here, this feeder chart, because I do want to look at a continuation chart real quick, because there are some trend lines, supportive trend lines that are coming up, but it's all about how you use the continuation, right? If you do a nearest, it looks very different, but the daily continuation chart, so this is just taking the August feeder cattle and plopping our prior month futures right before it. The gap up here is not, it is a gap, but it's not real, right? Because it's really just the roll from one contract to the next, or when it, picking up the other one, excuse me, where it left off. But nevertheless, we have this channel higher in the feeder, and we bounced off of this 170 figure. I mean, it went a little lower, went through the figure a little bit and came up, but we bounced from it. So heading off this trend line, heading back down to that level, could get pretty hairy. Feeders 160, 160 will be my next level I'm interested in. Below that could be 140. Continue to watch this, but I'm not loving this constructive price action to the downside. Lower lows and lower highs in their swings, falling below the 200-day moving average, falling below on at least that continuation chart, right? Falling below the 100-day and 55-day moving averages here on just the August feeders. And that 18-day, not as respected in the feeder cattle, but I actually respect some 55-day, a lot more. So you can see they're coming up and testing as resistance. A little overbought in the RSI. Maybe we're getting to a point where we're going to roll over. All right, and last but not least on everything today, our calendar spreads for the row crops. July Dees corn. Back above their 18-day moving average, flirting with the 55-day, above the 100 and the 200-day moving average. Looks to me like we have a bit of a sideways, triangle, kind of at highs, but a breakout. Look for a breakout above 64 cents over, 70 cents over. That might encourage a fear rally this summer, or it might come alongside some fear rallies this summer. With bad production looming, or bad weather. Building a weather premium here would certainly help, but we shall see what happens. It is an inverted market. We're trading at 61 cents over. The market's been generally rather constructive the last several months after we kind of reversed that and took some carry out of the market here, or put some carry in, I should say, from the 100 figure as we pulled back all the way to 30 cents over. But we've, bounced from there. Concern, of course, we made a 50% retracement of this entire decline, but until we break below 55 cents over, kind of feels like the market wants to go higher. More interestingly to me, though, is the July, November soybeans making a bit of, putting in a firm bottom here. And this looks like a pennant. This looks like bullish. And let's not, let's not forget we're oversold now in that RSI. All doing so above the 126 area where we broke out from, tested support, moved to new highs, and have arguably been, flagging in a range above those highs. So could we get to $2, $2.50 over, or $2 or $2.50 over? Absolutely. We've been much, further than that, but that would also likely entail, beans rallying a few dollars over the next couple months, and that's gonna be a long ways off. All right, I lied. One more chart. Dollar index. What a move this thing has made. Let's do the daily nearest. That was the appropriate. Okay. So we've been talking about the dollar index a lot over the last couple of years because we're commodity traders. And if you're not paying attention to the value of the currency you're buying commodities with, aka inflation, you are missing part of the pie in when we talk about commodities. So this 90 figure, I mean, just real quick, the 90 figure, I was anticipating or looking for a potential breakdown below that area. If we had seen that in a run down to 78 or whatever, we would have been reversing back into the range we were in from 2008 to 2014 for the dollar. But it looks like the dollar has established a new range, and we are coming up on the prior highs of that range and arguably reversing dollar weakness that we've saw from the last 20 years pretty pretty quickly here. Keeping in mind the dollar index is only an index of a few currencies. It doesn't involve every currency, but certainly the most liquid and the highest traded pairs: euro, yen, pound. I don't know why the Swedish krona and Norwegian krone, might be wrong about those, are in there, but they are. All that being said, it's heavily weighted to the euro currency. But the rally here, breaking above 104, really, 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 really got to kind of go back in time, start finding some levels. There we go, that we could potentially get up to. So, yeah, old levels in the dollar index above here. There is not much that we would find until we get to 124. In a rate rising environment, with a hawkish Fed, rising U.S. interest rates means a stronger U.S. dollar. Simply put, the value of the U.S. dollar is relative to its carry earned from foreign central banks and from any trader or investor. The value of the dollar is going to go up as people buy dollars with foreign currencies. And because the U.S. has now a higher interest rate than many places in the world, let's use Japan, for example, you're going to see a carry trade reverse. For a long time, Japan attracted capital. You could borrow money in the United States or from other places in the world, or borrow money, I should say, from Japan, in Japan at low interest rates, and go lend it out at other places like Australia. That was not true between the dollar and the yen until more recently. And now that the dollar is starting to go up in value relative, or well, interest rates on the US dollar, the amount you can earn for having US dollars and lending US dollars out is higher than, say, how much you can lend money or borrow money in Japan. Convert that yen, you just borrowed yen at a lower interest rate, just call it 0.5%. Or 1%, wherever I don't know where their bonds are trading, but it is significantly lower than where the U.S. is now. I mean, heck, we just probably doubled in this last rate hike what Japanese bonds demand. But the point is that if you can borrow money cheaply in Japan, convert that money to U.S. dollars by buying U.S. dollars with your Japanese yen, and then lend those U.S. dollars out to people who want to borrow U.S. dollars at a higher interest rate, you effectively just have risk-free returns in what's called a carry trade. Now, there's not actually risk-free returns because the great equalizer in this equation is, of course, that swap between yen and dollars. So you will absolutely see bag holders of the carry dump their carry asset. So carry trade currencies oftentimes take the staircase lower and or staircase up and the elevator lower, with the intention that they slowly accrue that purchasing from individuals. But because the currency isn't really wanted by the foreign entities that are effectively lending out their currency in your currency's terms, they don't care about dollars, or Japanese banks don't necessarily care about dollars because they need to repatriate all of their yen back to Japan or all their value back to Japan to pay taxes once a year. In doing so, all of that US dollar needs to be converted back to yen at some point too. And that, quickly on a chart of the currency will reverse the valuation in minutes. All that being said, rate rising environment, bullish for the US dollar, not necessarily bearish for stocks as we saw. So an interesting night we've had. I hope everybody's enjoyed it. It's been a lot tonight. We've talked about a whole lot. Get in touch with us over here at Zaner at 312-277-0110. You can find me at Twitter at Daniel Hussey Jr. Reach out to me via Facebook right here at Dan SOTD, or shoot me an email at dhussey@zaner.com. Always looking to expand our ability to help you with your trading and marketing needs. So have a great evening, everybody. I'm going to go get a little tyke down to bed. If he isn't already, he should be. But we should keep a watchful eye on these markets, because I think we're at a couple lines in the sand, as we saw. It doesn't really matter where you look. I think we're really much at those big lines that things could change here. All right. With all that being said, have a great night, everybody, and we'll be back with you as price action develops. Take care, everyone.